we've obviously got global uncertainty at the moment, particularly in the midst of the US government shutdown. Yet we take a look at markets, and we've just ended the last quarter, of course, and it has defied expectations, particularly seasonality there. So what should investors be looking at next? Well, we're joined by Roger Perrett from Freshwater Wealth. Roger, good to see you.
Thanks, Andrew.
It has been a stellar quarter, the past quarter just gone. So now we're looking for the December quarter as to what's next. And given markets are at record highs, inevitably that makes many investors a little nervous, doesn't it?
Yeah, that's right. Like the S&P 500's up 15% for the year. Over 5 years, it's up over 115%. So in 5 years, you would have doubled your money. So it's been an amazing period of time. But you're absolutely right. The challenge is, what do investors do when we're in, I guess, arguably a market boom?
Well, what should you be looking at then? Because it's often said, I guess, if markets are at record highs and you're nervous, perhaps you've taken on too much risk.
Yeah, that's right. I guess there's a few options that investors could do. The first option is sell everything. But I love a couple of quotes. One is the famous investor Peter Lynch, who says that more money has been lost predicting the next correction than actually just staying invested yourself. And there's another one by Warren Buffett that says, why would you jump off a perfectly good ship? So I definitely wouldn't be selling everything at this time unless you need the money. I'd be staying invested, even though I guess there may be commentary that we're due for a correction, or there may be one coming.
So what you've just got to filter out that noise, because there is a lot of commentary. And look, you talk to some of the technical analysts, they're saying, look, this is way overbought. This is a crowded trade. What should you be focused on then? Yeah,
that's right. Yeah, and often there's like the scenario. Yeah, this time's different. Do you know what I mean? Yeah, we've got to sell. We've got to sell. Do you know what I mean? But the market's up over the last 30 years. I think it's like over 830%. So I'd definitely be staying invested during this time. And one option is buying. Like if you've got money, would you be buying? I'd feel comfortable with investors buying right now if you've got the right time frame and you've got the right risk profile. And the right risk profile really means, I call it a sleep at night test, that you understand the level of volatility that you could go through. And as long as you understand the magnitude and the frequency that it could go down, I think it's fine to invest. One thing I would say, if you were thinking of buying right now, I'd be doing it in tranches rather than today. Is today a good day? Are we all in?
So dollar cost average.
Absolutely, Andrew. Yeah. So putting in a tranche today, a tranche say in a month's time, and another month. So evening it out. I think you can always be happy then, because if the market goes up, you're like, I'm happy we got in back at those lower levels. But then if the market does correct, you're like, oh wow, luckily we can get in now, it's lower. So buying is certainly an option if those couple of, principles are met.
Because, maybe that's the question. If you're not there, do you chase the rally or do you wait for the pullback and then get in?
Yeah, that's right.
How do you weigh that up?
Yeah, look, I don't think we can time the market, so I just really think that it's best to coming back to that sitting tight, and buying in tranches. So yeah. But sorry, you were going to say?
No, I was just about to say, at the beginning of a quarter or the end of a quarter, often we talk about rebalancing.
Yep.
Is that what an individual investor should consider as well?
Yeah, because what I guess there is a tendency, and a lot of investors basically just sit tight forever. But I guess there's an issue with that, especially when we've had a sort of share market boom like we're experiencing, because let's just say someone's risk profile was 70% in growth assets. During this time, their portfolio may not be 70% growth assets anymore, because the growth assets have outperformed the defensive. So maybe their portfolio is not 70% anymore, it's now 80%. And I like the analogy, when you've got like that perfectly manicured garden, balanced with trees, shrubs and small plants. If you let it go, the growth plants will just, take over everything else. And I think that's where investors do have to be careful in this environment. If they looked at their portfolio or they're not rebalancing, they actually could be exposed to more risk than they originally thought.
What sort of mix of assets do you think you need at the moment? We talk about obviously the traditional 60-40 portfolio, but then you take a look at whether you should have a significant cash position, gold, crypto perhaps.
Yeah, that's right. Yeah, look, I think the actual asset allocation all depends on the client. But in general, if you wanting greater long-term returns and you're happy to withstand that volatility, I think more allocation to growth assets is fine. But likewise, if you don't like the frequency and negative return, we're better off sliding back and having defensive. So it's a difficult question to answer because I think it really depends on everyone's unique scenario. But but I think in terms of coming back to that rebalancing, I think now is probably a good time to look at that. And there's a few approaches that people should do right now to rebalance.
And what about the age-old question, Roger, of property versus equities?
Sure.
And particularly here in Australia,
Yeah.
given our obsession for property, over time, what do you do best in?
Oh, look, I think it really depends on what period you're looking at. Like, I'm not one of those people who say, all shares are all property. I think in a portfolio like both has its place. A lot of my clients are sort of retiring and they need income. So I think it's very difficult in terms of residential property to generate the level of income that you need to create a great retirement lifestyle. So depending on the person's situation, you may, allocate more of their portfolio to shares. But saying that, I think a lot of investors have allocation to property through their home. So do they actually need property? I guess it comes down to the individual and what their goals and what they need from their investments.